This is the History Lessons Podcast with certified financial planning practitioner, Patrick Huey.
Hey, I'm Patrick Huey. I'm the owner and principal advisor at Victory Independent Planning, and I'm also the host of the History Lessons for the Modern Investor podcast. And today, we're going to talk about 3 planning changes that could affect how you save, invest, and take money out in retirement starting in 2026. Now, these aren't headlines for tax nerds. They're the kind of quiet rule changes that if you ignore them, they can cost you real dollars over a 20 or 30-year retirement. And if you understand them, they can become tools to lower your lifetime tax bill and give you more control over your income. So in this video, I'm going to walk you through Roth-only catch-up contributions. Those are for higher earners, age 50 and over. We'll walk through the higher cap on state and local tax deductions, SALT or SALT. And we'll walk through a new deduction for seniors that opens up some interesting planning doors. And for each one of these, I'll give you the key questions you should be asking right now. So let's dive in. Change number 1, Roth-only catch-up contributions for higher earners. So if you're over 50 and you're making a good income, this one's aimed straight at you. In plain English, here's what's happening. If your wages are above a certain threshold and you make catch-up contributions to your 401k or similar plan, those catch-up dollars will have to go into the Roth side of the plan, not the pre-tax or traditional side. Translation, you still get to save more. You still get to participate in the catch-up, but you're going to lose the immediate tax deduction on those extra dollars. Instead, you're going to be building tax-free money for the future. Who does this hit? Well, if you're age 50 or older and you're making catch-up contributions at work on top of the regular maximum contribution, you have higher W-2 income, think upper 6 figures, especially in executive or professional roles. If all those things apply to you, this change is going to do at least 3 things to your overall plan. First, it's going to shift when you pay tax. Pre-tax catch-ups lower your tax bill this year, the year that you make the contributions. Roth catch-ups do not. So you're choosing, or it's being chosen for you, that you will pay tax now and that your future withdrawals will be tax-free. None of that's necessarily bad, but it is something to think about and plan for. Second, it's going to change your future tax picture, right? More Roth now can mean lower required minimum distributions, RMDs, later in retirement after age 73. It can also mean more flexibility to manage your tax bracket in retirement. Remember, Roth distributions are tax-free. And less income showing up on that future tax return, income that could cause more of your Social Security to be taxed or push up your Medicare premiums. So that's a good thing. But you have to wait for it. And that raises a strategy question. If catch-ups are Roth only, is that still the best place for your extra savings? Or should some of that money be redirected to other places? So here are the questions to ask. Given your income and age, will your catch-up contributions have to be Roth only in 2026? That's number 1. If so, does it still make sense for you to max them out? Or do you want to rebalance where your next dollars in savings go? Third, how do Roth-only catch-ups change your plan for RMDs, Social Security taxation, and your overall tax bracket in retirement? Somebody should already be modeling this out for you, okay? Not waiting for you to find out when your paycheck starts to look different. All right, moving on from the Roth catch-up, we're going to talk about the higher SALT deduction cap. That's change number 2. So SALT, the deduction for state and local taxes. If you live in a high tax state, California, New York, New Jersey, Illinois, just to name a few. This matters a lot more to you. For years, the SALT deduction was capped so low that many high-income taxpayers couldn't deduct a meaningful portion of what they were actually paying in state income tax, property tax, and certain local taxes. With that higher SALT cap, more of those taxes can become deductible again if you itemize instead of taking the standard deduction. So why does this matter for retirement income planning in 2026? Well, because suddenly timing matters again. Okay, the year you realize a big capital gain, the year you do a Roth conversion, the year you pay certain large expenses, the year you bunch charitable gifts, all of that interacts with whether you itemize or take the standard deduction. And a higher SALT cap, state and local tax, gives us more room to work with. Again, the timing matters. For example, if you're in a high tax state and you're planning a sizable Roth conversion, we might time that in a year where we can stack higher income tax from the state because of the conversion, some property taxes, charitable gifts through a donor advised fund or another strategy, so you get more benefit overall from itemizing. If you're already retired and you're pulling from IRAs, a higher SALT cap might change which account we tap first in some years because the marginal value of the deduction has changed. So the question here is, with the higher SALT cap in 2026, am I likely to itemize or still use the standard deduction? Second question, are there things that we could bunch together like charitable giving or Roth conversions to make better use of that timing and of itemizing? And third, how does this change our withdrawal plan from my different tax buckets, pre-tax Roth and taxable accounts over the next few years? Again, this is not about memorizing the cap number. It's about using the rule changes as a planning lever, especially if you live where taxes are already a line item in your retirement spreadsheet. Okay, change number 3 is the new senior deduction. The third change is a new deduction for older taxpayers, a senior deduction layered on top of what's already there. Think of it as a little bit of extra runway, more income you can have before the IRS starts to take their bite. What it looks like in practice is this. Once you cross a certain age threshold, usually 65 and older, you qualify for an additional deduction amount. And that extra deduction sits on top of your regular standard deduction, and it interacts with your itemized decisions. The end result is simple. You can have more income and still pay tax at the same or even a lower marginal rate than before. Congratulations. Now, a lot of people hear that and think, great, I'll just save a little on taxes. But the more interesting question is this. What does that extra deduction let you do strategically? Because for retirees, it can create more room to take IRA withdrawals in a relatively low bracket. It can make partial Roth conversions more attractive in certain years. And it can give you a little more flexibility to realize capital gains. For example, rebalancing your taxable portfolio without jumping as far up the tax ladder. Combined with your Social Security, pensions, and portfolio income, this senior deduction becomes part of the equation that answers a few questions. Questions like, how much income can I safely recognize this year without paying more tax than necessary? So the questions you need to ask yourself or your advisor are, hey, once I qualify for the senior deduction, how does that change our plan for IRA withdrawals and maybe Roth conversions? Second, can we map out how much income I can recognize each year, wages, IRA withdrawals, capital gains, whatever, without bumping me into a less attractive, i.e. more penalizing, tax bracket? And third, does this open a window to clean up any tax clutter, like big concentrated positions, while my effective tax rate is lower. Now, the goal isn't to win some obscure tax deduction game. It's to use the rules to your advantage so you can support your lifestyle without giving the IRS an extra tip. So, bringing this all together, individually, each of these changes might sound technical. I understand there's a lot of jargon around taxes. But the Roth only catch-up contribution for high earners over 50, the higher SALT cap that changes the value of itemizing, and the new senior deduction that quietly widens your low tax runway. Together, they all point to the same reality. Retirement and retirement planning isn't just about, do I have enough money? It's not about what's your retirement number or some other marketing nonsense that we've been fed for the last few decades. It's more about, am I using the rules of the system intelligently so I get to keep as much of that money as possible over the next 10, 20, or 30 years? And that, my friends, is where good planning earns its keep. If your current advisor hasn't walked you through how these 2026 changes affect where your next dollar of savings goes, how and when you convert to Roth, the order in which you tap your accounts in retirement, and how much you're likely to pay over your lifetime, then you may be getting investment management, but you're not getting advanced planning. Here's my invitation. If you're 50 or older, earning well or already retired, and you want to know how these specific changes could apply to you, use the link in this video and schedule a call with me. It's that simple. We'll look at your current savings and withdrawal. We'll map how these rules interact with your income, your state taxes, and your age, and we'll identify where there may be opportunities for meaningful tax savings or better sequencing of your decisions. And at the end of that conversation, you should be able to say one of two things. One, I'm on the right track. Or two, I'm leaving some real money on the table and I need a better plan. Sounds helpful? Click the link, schedule a time, and let's see what these changes can mean for you. Thanks, everybody.